Well, good afternoon, everybody, and thank you so much for joining our quarterly market update. We're going to be discussing the Q3 2021. And with me today, I have two of my colleagues, Peter Watson and Adam Jekyll. We are all part of the Watson Investments team, a team of holistic wealth managers that help clients invest and financially plan for their future. If you have any questions for either of us, please feel free to email us or give us a call. We're going to be talking about inflation and the risk of inflation today as one of the topics. And if you would like to have an inflation risk assessment done, please feel free to use the link that's in the chat box to schedule a conversation. For all of our clients that are watching right now, this is something we look at always for you. We're always looking at that. It's part of the cash flow projection. But if you know of somebody that could benefit from this, feel free to send the link off to them. As well, for anyone that ends up watching this after the fact on our YouTube channel, the offer is for you as well. So feel free to please schedule an inflation risk assessment. Also, if you are not on our newsletter, please make sure you sign up for that so that you can get any resources that we have, as well as invitations for future upcoming webinars. And you can also follow us on social. We have Instagram, YouTube, Facebook, and LinkedIn. In the next 30 minutes, we're going to be covering the last quarter's performance, looking at volatility, segmented returns, asset class returns, and then we're going to be discussing inflation. So how does that affect portfolios and how will it impact futures? And as always, we add an extra section at the end of what else can you be doing? And this is some extra financial planning tips and suggestions.
So we're going to be talking about investments, but let's now look at investments through the eyes of you, the investor. We humans are not exactly programmed well for investing. There's a lot of emotion that can go into an investing cycle. You invest your money and you're optimistic that things will go well for you and your portfolio increase in value. And when it does, you are really quite happy. You're elated. You're thinking this is a good way to go. And then if the market has a correction, you become a little bit nervous. And if that correction continues, you can downgrade your emotions to fear. That's not a happy thought. And then back up to optimism and the cycle starts again. I'd like to just say one thing on the fear. If you invest over a long period of time, and of course there are market corrections, that's just part of what it does, a certain amount of fear might actually be felt by you, and that's uncomfortable. But realize in the context of the overall ups and downs of the market, it's just part of investing. And yes, not comfortable when the market goes down for a month or 6 months or whatever the time frame is. Yes, you're not comfortable, but realize it's just part of the ebbs and flows of the stock market.
And when we look at that very strong emotion being fear, we'd like to try and quantify it. So what we have here is what's called the VIX, also called the fear index. What it does is an expected measure of price fluctuation in the next 30 days. So it tries to quantify investors' uncertainty in the current market with all the conditions. So we see that the low was in 2021. In the summer, it was around 15, and it peaked in September at 25. Now, over the quarter, it increased 46%. That's a large increase over the quarter, primarily driven by investors' concerns and uncertainty surrounding inflation. It was already this morning that I saw 2 more articles in the Globe and Mail about investors' concerns regarding inflation. Now, it finished the quarter at just over 22 points, but it's important to have context to what does 22 points mean. When we take a view of this index over the full year-to-date period, it gives us a better perspective. We see that there are significant peaks and troughs. It was over 35 for a couple points, and now it's dropped off quite substantially from that peak. So although this quarter, it has risen quite drastically, for the year, it is still tapered off since those pandemic fears.
And when we look at the S&P 500 and what's happened in the past quarter, there was some movement, but really in the end, the quarter ended up being not too much different from the start of the quarter. It was at the end of it, it was down by negative 0.2%.
The randomness of quarterly returns. This is one of my favorite charts in all of finance. What we've done is this chart looks at the last 4 years of performance figures for 8 separate categories: Canadian stocks, US stocks, bonds, and so on. And we believe very strongly in taking a long-term approach. And to illustrate the advantages of taking a long-term approach, Adam, if you could mark the top left of that chart. 4 years ago, the best performing asset class of all 8 was emerging market. And not only was it the best in that quarter, it continued being the best for the next 2 quarters. And so at that point, if you're a short-term investor, as opposed to us being long-term, if you're a short-term investor, you might say, well, this is the winning horse. We got to bet more money on that. And you might shift some of your other assets in your portfolio towards emerging market. And then after another quarter of being up and another quarter of being up, you might even shift more money in. Well, now, Adam, let's look at the worst performing asset classes on the bottom row. Over the next 6 quarters, 4 of those quarters contain the darling of the past, emerging market. So just take a second and look at the chart and look at the colors. And again, each color represents an asset class that you can invest in. How can anybody expect in the short term that they can consistently, with accuracy, pick the winners? It is, in my opinion, in our opinion, it's just impossible. So we don't think that's a good thing to do. So if that's the case, what is a good thing to do? Well, take a long-term approach and use evidence. We believe strongly in evidence-based investing. Now, there's been a lot of research done in the world of investing, starting back in the 1950s, 1960s, and decades up until today. And there have been 4 things that have been learned about the market. If you want to have an advantage to increase your expected return, you would then shift your portfolio towards factors that have in fact been profitable in the past. The first one is market. We know, and most people understand this, if you are a long-term investor, you're going to make far more money in stocks than you are in bonds. If you look at the last 100 years, that's just basically the way things have worked out. And we imagine that will continue. Company size. Small companies have a higher expected return than large companies. So you want to have, you don't want to ignore large companies, but you want to have a little bit more representation in the small company area. Relative price. No, relative price is a pretty hard definition to explain. So we'll just suffice to say there are 2 categories, 2 main categories of stocks. One is value and the other is growth. The value stocks over time have historically outperformed. So you want to have a little bit more on the value side than the growth side because of that. And finally, profitability. Companies that have been profitable in the past, that profitability tends to continue, and therefore those stocks tend to be a little bit better than the average. Now that's providing 4 factors, things that you can use in developing your portfolio, things that we use in developing your portfolio for you. But let's have a quality control. Let's put the magnifying glass on this just to make sure this all makes sense. You want to, when you're looking at these factors, see the writing on the right side of the chart. You want to make sure your theory is sensible, because you can throw a lot of numbers at a computer and the computer will say, well, there's a trend here and a trend there and back and forth. But you want to make sure that it's sensible, because if it's not sensible and it's just random numbers, it's not likely to continue. You also want a factor to be persistent. Now, what that means is if you have an examination period in your research, change the starting date, change the ending date, change both dates, move around to different time periods, because if something's a good idea in one period of the time, it should be a good idea in other periods of time. You should also make sure the factors are pervasive. What I mean by that is if something works in North America, so the United States, Canada, does it also work in international markets? Does it also work in emerging markets? Look at different markets just to make sure, it's sort of the acid test, to make sure that really there's some logic and sense into that factor. And finally, once you've got factors that can tilt your portfolio a certain direction and lead you to higher expected returns, you want to make sure this can be implemented on a cost-effective basis. You don't want to have a great idea, but it's too expensive to implement. So cost is very important.
So when we look at the different ways of classifying stocks and global real estate and fixed income, what we see in this past quarter is lots of green, lots of positive returns, also some negative, all in the single digits. And I'm going to take what Peter was talking about is relative price, so the difference between value or growth companies. So we're going to take that as the example today. So for Canadian stocks, what we saw is value ended up being positive, growth was negative. But for US and international, what we saw is both positive returns for the value companies, but a higher positive return for growth companies. And when we take a longer term look at these same different ways of classifying stocks, so the company size, relative price, and profitability, what we see across different geographical regions, again, I'll take relative price as the example. So what we see is for Canada, so Canadian stocks from 1977 to 2020, what we saw was for value companies, the return was 10.2%. And growth companies, 8.18%. So that's a difference of just over 2%. So what that means is that that premium showed up for value companies and it added an additional 2%. So when we look across to US stocks, we saw a 2.8% difference between value companies compared to growth companies. And in developed markets, excluding the US and emerging markets, we have almost a 4% positive difference between value and growth. So what this means is, well, if you're, depending on how you're trying to invest your money and what you're trying to do with it, if you have a broad diversified portfolio that does look at different geographical regions, well, it might make sense to have tilts towards premiums that have historically outperformed.
Will inflation impact my portfolio and my future? And for the portfolio, the answer is yes, with a caveat. Yes, it will in the long term, but in the short term, no, it doesn't. Let's review a little bit on how inflation works. Let's say that you had $100 to invest at the beginning of the year. By the end of the year, your $100 in terms of purchasing power will have been eroded by, let's say, 3%, which is typically what inflation has been. You lose purchasing power of 3%, so your $100 really shrinks to $97. So what you want as an investor is you want to recover what you've lost and then go on to make returns above that. So that's how it works. If you look at the S&P 500, so that's 500 of the largest companies in the United States, over the last 100 years, in round numbers, that index has provided a 10% return, but inflation over that time period has been 3%. So the real return, the after accounting for inflation return for investors has been 7%. But that doesn't always happen. Let's go to the next slide. Adam, if you could just highlight the red dots, just a line across. What those red dots on this graph, and this graph covers a 30-year period, that is the inflation rate. And so I indicated that inflation will have an influence on your portfolio over time. As we know, the stock market has a mind of its own. It goes up, it goes down. It doesn't pay attention to inflation, whatever. It just goes up and down. So there's no way that you can plug in inflation and therefore know what your return is going to be in the next year. That's just not the way things happen. So I said at the beginning, it's all about you. So let's think of you. This is a graph on what happens to various investments and inflation over time. So we've got a 36-year period. If you had $1 back in the mid 1980s and invested that in a treasury bill, now a treasury bill would be a short-term financial instrument that you would buy. It would pay an interest, and then at the end of the term, you would get your money back. Your $1 would have grown to $4. And that's double what inflation had happened during that time period. If you had put that dollar into short-term bonds, world bonds, you'd be up to $7. And notice how smooth the treasury bill and the bond line is. It's pretty well, almost a flat line, no ups and downs and no drama. But on the world equity, your $1 over that period from the mid 80s would be worth $28. But again, look at how zigzaggy it is. Stocks that you never know what's going to happen. They do tend to go up over time, but that's over a long time, not a short time. So if you're looking ahead, you have to realize what inflation does and what categories of investments might be best in your portfolio and to what amounts. Now, I'd like to just tell you a little story about me back in the 1980s. I did notice that financial institutions had big plaques in their wall, big signs in their window, advertising GICs. And GICs were sort of pegged as kind of the safe investment. The safe's a pretty strong word, so let's just examine what safe means. If back in the 80s, you had some money saved up and you wanted to take a holiday next year, you could put that in a GIC. It would be safe. It wouldn't be subject to market fluctuations because you might have your money in the market for next year's holiday and the market would go down and that's going to hurt. But that's not going to really hurt you on a one-year basis. But let's say back in the mid 80s, you were putting money in your retirement fund your retirement was going to start several decades down the road. Or let's say in the mid 80s, you had already retired and your retirement was anticipated to last many decades. If you had your money in a safe GIC, it would not have kept pace with inflation. So you might find yourself running out of money because inflation just makes everything more expensive. And the final slide is a good one, and I want to rename this one. I want to say this is a picture is worth 1,000 words. So this is a picture of a shopping cart, and that's you, the shopper. So you're out shopping tomorrow or next year. Does inflation affect your ability to shop? No, it doesn't. Not year to year, it does not. But if you're retiring a couple of years down the road, or again, if you're in retirement now and planning for many decades of retirement, things that don't keep up with inflation, investments that do not keep up with inflation, might not keep up with your requirement to spend money as you go. So basically, and Jennifer, you'll touch briefly on this, it's all about articulating your goals, determining what the asset allocation should be, what amount of bonds, what amount of stocks, what is right for you given your circumstances. Inflation is an important thing for investments, and it's an absolutely critical thing for investors to think of for their own personal well-being long-term.
So what can you be doing? Well, when we're talking about inflation, one of the things that would be very helpful is to look at a budget. So budget means very different things to different people, but we encourage everybody to, at least at a high level, basically take awareness to where your money's going and ensure that your values, short and long term, are really what you're actually spending your money on. So by taking a look at your budget, you could be, maybe you're still accumulating assets for retirement. So it's looking at least how much should you be putting away for the future. The budget exercise also allows people to realize how much they're spending today. And therefore we can take that amount and we can figure out, well, is that going to be the likely spending amount in 5, 10, 30 years? And what does that number look like? And we can talk about it in today's dollars. And then what we can actually do with that then is we have that number to actually put it into a cash flow projection. A cash flow projection is going to be a way that basically takes everything that you're doing with investing, with spending, and it accounts for inflation, it accounts for investment returns and market volatility, and it projects out to make sure that your lifestyle is sustainable, regardless of people's assets, regardless of spending patterns. The number one fear we hear about is the fear of running out of money. And so this is one of the ways to make sure that that doesn't happen and that you can comfortably spend how you'd like to spend your money. So taking a look at the cash flow, we always incorporate inflation. We always use the 100-year average of inflation, which Peter mentioned is around 3%. And so that's one way to really, and actually, I think probably the most effective way at looking at how inflation is going to impact you and your portfolio. And humans we're tough investors. We can sometimes be our own worst enemies because we have the emotions that go with investing. And even though some people maybe, let's say you've experienced the 2008 financial crisis, well, maybe the March 2020 declines, maybe that felt different for you because you're at a different stage of life. Maybe you're at a different earning power potential. Maybe you have more money in the bank. Whatever the reason is that even though we've been through market volatilities in the past, sometimes in the future, we can react and respond differently to those volatile times, and even actually the positive times. So sometimes actually when the markets are very strong, it can also skew our opinions and how we actually react. It might make us over risky or kind of chasing the returns, which from the checkerboard Peter was articulating for us is if you're chasing that return, how difficult that can be. So we can, you want to make sure that you have that risk tolerance that is right for you and your goals and objectives. And that does change over the time. And maybe your tolerance is building over time. And that's not necessarily a bad thing. It's just, we have to make sure that it's always based on, what you're trying to achieve and that's something sustainable. So if you go a little bit riskier in your portfolio, is that going to be something that you're comfortable with when the market goes down substantially next? And how are we going to plan for the portfolio to actually withstand those times? So it can be difficult as human investors, but some of the things that help us is by having a financial plan in place. So having that financial plan, working with a team of advisors, having a team is really important. And making sure that you feel very comfortable to openly communicate how you truly feel at different points in time about the market, about your personal circumstances, so that we can better understand and make that suitable financial plan for you and help you through all of life's phases. And there's a study, we've referenced this study before, but Vanguard did a study which I thought was great. It looks at the additional value that advisors can add to clients' portfolios. And they ended up being able to, as best as they could, quantify, and they look at, and they said that, it's about a 3% additional value that advisors provide. And a big part of that is the behavioral coaching, which it kind of helps with humans can be our own worst enemies at times when it's our own money and we don't have a plan in place that makes sense. So that's a huge value add for advisors, as well as doing things like asset allocation, asset location, withdrawal strategies, making sure there's rebalancing appropriately, spending. So with the withdrawals that you do, so how you actually invest the money in which accounts, but also how you withdraw the monies. That is huge ways that advisors that do all those things for clients can add additional value. And a reminder, please use the link that's in the chat box, schedule that inflation risk assessment. We'd really like to have that conversation with you, and make sure you're signed up for our newsletter. You can always go to the homepage of our website, and there's always a free consultation button there, as well as at the bottom, there's the how to sign up for our newsletter. and follow us on social. Part of one of the next upcoming newsletters will include a recent article Peter wrote that is soon to be published, and that's all about inflation and the concerns and risks. And he has some more articles that will be coming out in the near future too. So if you're on that newsletter, you're going to receive that information. And if you can tune into our next webinar, it is on snowbirds and what you need to know. So this is for anybody spending time in the States or considering spending time in the States. We're going to outline kind of the key things to remember and considerations while you're there. So please feel free to email adam@watsoninvestments.com to make sure you're signed up for that webinar on November 17th at noon. As well, we will be sending it out in our newsletter. So again, if you're signed up there, you can register for that. You can also go to our website. We now have a new tab there that has all of our upcoming and past webinars. So you can actually find these directly there. And we will be posting the 2022 webinars shortly. Thank you so much for joining us today, and please reach out with any additional questions.